depending on the sector that you like. ETFs and index funds are a really good way to diversify your portfolio and spread your risk. In fact, this might interest you. Warren Buffett recommends that most investors adopt passive investing in index funds instead of other strategies. I am happy to tell people the same thing I've told them before, but they'll never get to see most of them. But if you do, that's the most, first thing to do, if you want to invest for the long term is index. And it's the S&P 500 index. Let me give you a figure that'll blow your mind. I think I bought my first stock when I was 11 years old. It was the first quarter of 1942, shortly after Pearl Harbor. I spent $114.75, create 3 shares, $114.75. If I put that $114 into the S&P 500 at that time and reinvested the dividends, think of a figure to what it would be worth today. Oh man, the answer is about $400,000. This investing strategy is for the more illustrious type. The guys who don't mind a little bit of risk. It's like the attacking style when you play a game of chess. Growth investing is where you invest in companies that have more risk to them, yes, but have more potential on the upside. The innovative stocks, the technology stocks, the disruptive stocks that are changing the world. The Teslas of 10 years ago. And growth investors have done very well over the past decade as the world has changed and as technology has spread. Growth stocks like Amazon, Apple, Tesla, Netflix, Alphabet, and Matter all shot up like a rocket. The key with growth investing is to weed out the good growth stocks with a proper business model from the junk, because there is a lot of junk. Also, you want to try and invest at the start of the bull market instead of at the end of the cycle. And this is why I'm kind of a little bit wary of growth investing at this point in time, as we have experienced already a long bull market and that bull market is going through some turbulence, we can say that in the least. Cathie Wood, Chamath Palihapitiya are 2 investors who do follow a growth-oriented style of investing. Although they did well to start with, they have struggled a lot this year, especially Wood. As we can see, her fund ARK Invest started with a bang, but it is now broken even. It's at the same price that it was a long time ago. Be wary when you adopt this style of investing, because this style will struggle the most if the economy continues to be on edge. While growth investing struggles when the economy is unstable, volatility investing thrives. People like Michael Burry from The Big Short love these types of conditions. I'm not sure if you've watched the movie The Big Short, but essentially in that movie Michael Burry shorted the housing market in 2008 and made a bunch of money as the market fell. Michael Burry profited from volatility. Volatility investing. You can either do the Michael Burry approach and short stocks on the way down, or you can do the George Soros approach and ride stocks on the way up. He also short stocks on the way down, but he does ride stocks on the way up. This approach can be quite risky, and you need to have your finger on the pulse at all times, but if done right it can make a lot of money. Those are the 5 styles to investing in the market. If you want to see the styles that I personally implement and the way my portfolio looks like, there is a link to that in the description below for premium viewers. Have you ever been on those stock websites and you see hundreds of ratios and numbers everywhere on a screen? Yeah, it can be pretty confusing for an experienced investor, let alone a newbie. So let me explain some key ratios and numbers to know if you understand them already. Skip to the next one. A good test for you all to do is how many of these 12 ratios and metrics do you already know? Okay, tick them off the list as we go. So price per share or price per stock simply tells you the price that will cost you to buy a share. Pay that price with your stockbroker and you will become a shareholder. The market cap of a stock tells you the total value of the business. Market cap is calculated by getting all of the shares in the business and multiplying it by the price of those shares. For example, Apple's market cap is $2.3 trillion. So if you wanted to buy the entire business of Apple, you would need $2.3 trillion. Tesla is $525 billion. Netflix is $140 billion. The dividend yield compares the price you pay for a stock to the yearly dividend it gives. So if the dividend yield is 1.5% like it is with Walmart, if you bought $100 worth of Walmart stock each year, you would receive $1.50 in dividends. Right now the average stock on the American market has an average dividend yield of 1.66%, so use that as your benchmark when looking at dividend stocks. If you ever see the letters EPS, that stands for earnings per share. Earnings is the same as profits, aka revenue minus expenses. Obviously you want